We've learned how to allocate the cost of physical or tangible assets through the process of depreciation and costs associated with natural resources through the process of depletion. Although we call them different names, they're both cost allocation processes. Now we reach the last category of assets whose costs must be allocated, intangible assets, and the last name for an allocation process, amortization. Costs associated with acquiring intangibles, patents, copyrights, franchises, customer lists must also be amortized over time. Same core idea you already know, with a couple of important points that are unique to intangibles. With intangibles, before you compute anything, you have to ask one question that determines everything. Does this asset have a finite useful life or an indefinite one? This single distinction decides whether we amortize at all. A patent has a finite life. It legally expires. A franchise might run for a set number of years. Those get amortized. But some intangibles, like goodwill or a renewable trademark, have no foreseeable limit on how long they'll generate value. Those have an indefinite life. And here's the twist, we do not amortize them at all. You'll remember that land is similar. For a finite life intangible, amortization works just like straight-line depreciation, and straight-line is almost always the method that we use. We take the cost, subtract any residual value, though for intangibles, residual value is usually zero, and then spread it over the useful life. One nuance, we amortize over the shorter of the asset's legal life or its useful economic life. A patent is legally protected for 20 years, but if the technology will realistically only be valuable for 8 years, we're going to amortize over 8. Here's a quick example. A patent purchased for $80,000 with a useful life of 8 years and no residual value gives straight-line amortization of $10,000 per year. The journal entry is to debit amortization expense and credit often directly to the intangible asset account itself, rather than to a separate contra asset or accumulated depreciation or amortization account. Now, back to indefinite life intangibles. Goodwill is the classic example. It's not amortized. Think about why. Goodwill represents things like reputation and customer loyalty that don't have a predictable expiration date, so spreading the cost over some arbitrary number of years would just be guessing. Instead of amortizing, these assets are tested for impairment, at least annually. We check whether the asset has lost value, and if it has, we write it down. We'll cover the mechanics of impairment later, but for now, the key fact is the dividing line. Finite life means amortize. Indefinite life means test for impairment instead. 2 quick notes to round this conversation out. First, software development costs get special treatment. Once a software product reaches a technological feasibility, certain costs are capitalized, and the amortization is the greater of the straight-line amount or a percentage of revenue calculation. Just know that it exists. The detail can wait. Second, a GAAP versus IFRS difference worth filing away. Under US GAAP, we never revalue intangibles upward, but IFRS does permit revaluation of certain intangibles to fair value when an active market exists. For this course, we're only applying US GAAP, but it's the kind of difference that the CPA exam does sometimes like to test. Now, let's zoom all the way back out because we've now closed the loop on the whole process of cost allocation. One single idea, allocating an asset's cost over the periods that it benefits. Wears 3 different names depending on the asset. Tangible assets, depreciation. Natural resources, depletion. Intangibles, amortization. The mechanics rhyme every time: a base to allocate, a life to spread it over, a method to do the spreading. Master the concept once and you've mastered all 3. To summarize amortization specifically, the first question is always finite versus indefinite life. Finite life intangibles are amortized, almost always straight line, over the shorter of legal or useful life, usually with 0 residual value. Indefinite life intangibles like goodwill are never amortized. They're tested for impairment annually instead. Software and IFRS revaluation are special cases to be aware of, and the big picture, depreciation, depletion, and amortization are the same concept of cost allocation wearing 3 different hats.